Welcome to Soonicorn Nation, a podcast for entrepreneurs by entrepreneurs, brought to you by the Soonicorn Collective. My name is Mohammed Tariq, founder of Earth, and I have been an entrepreneur for the last 20 years.
My name is Dr. Siva, founder of Soonicorn Collective, and I've been an entrepreneur for the last 40 years. The Soonicorn Collective is a peer-to-peer leadership and learning community for mature and growth stage entrepreneurs. While our in-person and live engagements are exclusively for members only, we believe that the knowledge gained and the lessons learned should be shared across the wider ecosystem and society at large. And that's how this podcast was born. We hope these learnings will accelerate your entrepreneurial journey and perhaps pave your way to becoming Malaysia's next Soonicorn.
The opinions, views, and content expressed on the Soonicorn Nation podcast are those of the entrepreneurs and guests featured and do not reflect the official policies or positions of Proficio Consultants, Penjana Capital, or the rest of the Soonicorn Collective. Today, it is my pleasure to have Omar Fateh and Alvin Chin as my guests on this special episode covering the recently held MBAN Summit. Welcome, gents.
Thanks.
Welcome. Thanks for having me.
Can you please introduce yourself? Let's go with Omar first.
Sure. Thanks, Mo. It's a pleasure to be here, and thanks for inviting me. I love the work that you do at the Soonicorn Collective.
Thank you.
So I'm an investor for about 20 years. I started off training as a chartered accountant, did the normal Big Four route, audit, corporate finance. Spent about 7 years in private equity at a local government fund. And then after a year off, I took in 2019 off. For 2 years after that, I worked with a small social enterprise as a financial advisor. And then I worked with another large government fund, and they're doing impact investing.
I might be familiar with that.
Yep.
They sit on my cap table. Alvin?
Yeah, so I think I share quite a similar, at least for the start, right? I was with trainers and accountant, and then I spent a number of years in what I call a corporate-backed startup venture in the travel space. And so that led me to being involved in travel for about 12 years. One was with affiliations with AirAsia and Tune, and then the other being a Kuala Lumpur-based travel tech startup. And we used to call ourselves like Malaysia's best kept secret, because we were doing enterprise sales as a startup, selling to airlines across the world. We had clients in the Middle East, in Europe, in Asia. So but we had never spent a single dollar in marketing. And we were purely enterprise sales. We sold directly. The only kind of promotion about ourselves was through trade shows, right? And we were lucky enough to have really good investors supporting us. So I was there for about 8 years, helped raise a seed round all the way to a Series B. And I don't know about you guys, but being in travel, if you heard of something called COVID, that didn't really help our business. But we still made enough during those 2 years of COVID to gain an interest from a buyer. And we sold the business about 2 years ago. And since then, I've been kind of trying to give back what I've learned over the 8 years running a company, all the ups and downs, all like the silly things that we do, lessons that we learn. And now I'm part of Guide, which is an entrepreneur development service provider. And yeah, so I spend most of my time now working with entrepreneurs in terms of how do we scale, structure their business as well. And recently been also trying to learn a little bit more about investing, right? What I say, money where your mouth is, right? And learn from that. And in order to help entrepreneurs, I think like being a bit invested in the ecosystem directly, I think what I've learned like in 2 years really has been tremendous. It's been such a good for the part, right? Like putting money in, you learn, but what I also come to understand is that there's no quick exits, right? When you're an entrepreneur, and I was lucky enough to be part of like working with the founding teams. We had so much control over the business. We had control around the trajectory. But once you're on the other side of the table, you put $1 here, you don't know what this guy is going to do, right? And you have no control. So how do you influence people in the room? There's so much to learn, just being on this side.
Well, one of the things that made you very relatable to me is that I also, in my 20 years of entrepreneurship, have had a similar experience. I've had a venture-backed company. We have raised multiple rounds. And then, unfortunately, at the end, we were disrupted and we couldn't continue. And one of the things that struck me was that, yes, of course, you probably, when I first met you and you told me the story, it felt like you, maybe part of you would have wished for a different outcome, but nevertheless, you still accepted that entrepreneurship is about the journey, not the destination. And you still thought that you are going to get back on the horse and do something else. It could be for now guide, but maybe at some point you're going to do startups again. And also one more thing that I also admire is that you still managed to keep a positive relationship between you and your investors. Your startup, I think, raised upwards of 10 million USD through the different rounds. So I'm not sure, you don't have to reveal, but I'm not sure if the investors got the desired outcome of investing in the startup. Nevertheless, you still have a good relationship with them, and some of them even supported you on your next project, which is Guide.
Yep.
So maybe you can tell us a bit about what were the behind the scenes that made you and that investor so close that they would still support you even after you didn't make them money.
I think it's going to be a cliche answer to begin with, and feel free to ask. We try to do right by our customers first, and then second was try to do as much as we can to be right by our investors. Right, we had to do a difficult deal in that time, and the point was that our customers were relying on us for critical systems. And if we went down, that means part of their business goes down as well. And if
that's in the order of millions or billions or what?
Well, prior to COVID, that's in the order of like for on average per client would be like 8-figure millions. Yeah. So yeah, I mean, we if we let anyone down during that time, what it means is that we'll never start another business doing travel again. Like it was kind of that driven by that simplicity around like, if we screw this up, no airline would want to talk to us ever again, because you screw up big time. We count on you. You're the only service provider. It takes us 6 to 12 months to run a tender, to onboard new systems, and if you go down, part of their business goes down as well.
So not much pressure, basically.
Yeah, and we were driven just by that, as that point about like, if our investors weren't gonna continue the journey with us, you have to let us find other alternatives. So we had to put a difficult deal together, and we explain our thought process around that. Like, this is why we're doing this.
So the deal was about divesting the assets of the business, right?
Yes.
Not the business
Yep.
is not still around, but basically the assets of the business
Correct.
were sold.
Yep. And that's gonna be, that was a tactical nature of the deal. Right? What we realized during COVID was that the assets itself, we could put technically any value to it, but it has to be a justifiable value, and that there are ways to justify that. If we're selling the company, for example, it's going to be like, okay, what are your cash flows? What's your P&L? How many customers you have? What are termination clauses of your customer contracts? And that was it. And if it was close to zero, then you get nothing from it, right? But if we're trying to position an asset sale, that's very, very different. So tactically, we went through a lot of these processes to decide what's the best way to extract value for our shareholders. So that was the secondary aspect of it. Right? Like we knew we couldn't fail our customers. And if we were to sell the asset, it may or may not come with the customer contracts. But if we fail one, the system becomes unreliable, nobody would talk to us.
But basically, just going back a bit to the point of the empathy between you and the investor saw while you were operating that you actually didn't do anything wrong. You were disrupted because of COVID and what happened to the travel industry. So in a sense, they actually didn't fault you for the failure of the company.
Yeah, and I think, to be fair, in there were a lot of others who failed in that short time frame, even within 12 months. We knew of a lot of travel startups who went bust because they couldn't sustain themselves. And we were quick to put together a plan to help the company. So in that sense, this is the cliche answer. We try to follow what we felt was right. And in the I still remember this very clearly, right? Like in the beginning weeks of COVID, the first people we then wanted to do right by was our employees. Um, it wasn't easy at all. I can tell you, like that. Those were the hardest nights to kind of like sleep through.
You were the CFO, so you
Yeah.
had to actually make the numbers
Yeah.
work somehow.
Yeah, and the numbers work with each person being kind of left out of the journey. So it definitely wasn't easy at all.
Well, thanks for continuing to give
Yeah.
back. Thanks for being positive, and thanks for your help. You were one of the team that helped me close my last round of funding from Kazana Dana Impact, and I think the last time we were in the same room, we were actually talking to Omar at Dana Impact, and I'm yeah. Thanks
Yeah.
for helping me out, and thank you also for the work that you did at that time with Dana Impact. So in today's episode, we'll be analyzing the MBAN Summit 2024, which was held recently at the Asia School of Business. Although usually these kinds of summits are mostly attended by angel investors. I mean, it's a business angel summit, right? And usually maybe there's a few startups that hope to meet, investors or something. But actually what we noticed this time around was that it's almost a 50-50 split. There was so many startups over there. The highlight of the summit was a fireside chat where Doc Siva, the founder of Soonicorn Collective, as well as the former president of MBAN, interviewed Carousell founder Marcus Tan. Carousell achieved, of course, a valuation north of 1 billion, and so it's already unicorn territory. Some of the collective members, myself included, we had dinner with Marcus actually after his segment at the summit, and then the next morning we got to spend the whole collective got to spend like 2 hours deep dive with him. So usually what we like to do on this podcast is that when we have collective events, we want to summarize the main learnings to other entrepreneurs who are watching, because we basically watching or listening because we basically want to open source the knowledge. Yes, the session was behind closed doors, but whatever we learned in that session, we believe is valuable, that we would like to circulate to the wider society. So if you guys don't mind, I'll just highlight a few bullet points of what we heard from Marcus, and some of it he didn't say on stage. Some of it was actually the stuff that he said only to us behind the scenes. So basically, Carousell started in May 2012. It was 3 guys. They participated in a hackathon. Then they got funded, with seed funding. They bootstrapped for 18 months. They used very sort of commando grassroots marketing tactics. They message potential sellers on other forums. They went and hang posters in public boards and stuff like that. So basically, he basically said that they figured at that time that it takes 7 impressions to convert to a user. So that's why they were basically just putting as much as possible. So they said that, okay, we're gonna put 100 posters, even if 80 get taken down, we still gonna have 20. So it was very, very commando kind of thing. So at first their strategy also product wise was also spray and pray. They didn't have a clear focus on what are the categories that they wanted to focus on. So they basically tried to be a marketplace for everything. And then later on they realized that, okay, some of the categories, like for example women's fashion, they actually were very sticky, because for example after the discount days, 11/11 or something like that, some people indulge in overbuying, and then there's a bit of a lag, and then after that all of that stuff ends up on the secondhand market. So they started to focus on some of those more sticky categories. So they've raised more than $375 million. They actually he actually emphasized that clarity is very important when you're raising funding. What are you going to use it for? The main point that you should always keep in mind is just don't die. And what that means is that don't ever spend more money than you've raised. It seems quite simple, but somehow people still fall into that. Okay. As Carousell grew, basically they evolved their vision. So now they're actually talking about making secondhand first choice. So it connects to sustainability and things like that. He talked a bit about how they try to bring in diverse thinkers into their team. And how they figure out whether people are diverse thinkers or not. They actually ask them to write a 6-page proposal of something that they would like Carousell to do. And then using that essay, essentially, they are basically able to dig a bit deeper into the mind of the individual. They've expanded to 7 markets. He talked a bit about how some of them were acquisitions. So, for example, they acquired Muda here, and he gave us a bit of behind the scenes of how that came to be. And then he basically said that they were using like a lot of locals who were studying in Singapore. Like, let's say they want to open in Vietnam, they would find Vietnamese interns that are studying in Singapore, and they would bring them at the HQ and then use them, who are locals in Vietnam, to actually research the Vietnamese market, which obviously makes sense. And then finally, he shared with us an acronym, HEART, HEART, which stands for humility, empathy, accountability, resourcefulness, and teamwork. So he basically kept saying relentless, resourceful. A lot of these words kept coming up during his talk, but there's also humility, empathy, and teamwork. So that is just a recap of what we heard from Marcus Stan. Now let's get back to the topic. What did you think of the summit? You were a speaker, but what did you think of it?
And I thought it was a very good way to showcase a lot of the early stage entrepreneurs and talk a lot about the journey that many entrepreneurs have been through. I really liked that session that you spoke about, Carousell. It's one of the rest stories of the Southeast Asian unicorn and someone who's been in Malaysia. There's a lot of perspective sharing as well from across the board. And I think what the summit did well was it gave a lot of kind of diverse opinions across the board. You had your investors, you had your angels, you had your entrepreneurs. You had the women's session as well. So it got a wide variety of people on stage to speak.
But they all said the same thing. I didn't see anyone disagree with anything.
So that's a different topic. Getting the right people and whether they say the right thing or not, or the same thing or not. Or so yeah, I know you're going to go a bit deeper into that, but yes, maybe the diversity of opinion was not as strong as the diversity of people invited to speak.
Okay, so I know Alvin, you didn't attend, but nevertheless, I mean, do you have any impressions of MBAN or the summits that they hold over the years?
I don't think I've been to an MBAN summit, but I do talk to a couple of angels here and there, looking at deals, looking at what different startups are doing, and of course, like you want to have stronger communities supporting startups, especially in the early stages of the journey. And then I've heard of MBAN for a very long time, but I've never kind of like thought to myself that that's going to be a place where I'm aspiring to be a part of. It never crossed my mind in that sense, right?
You work with a lot of startups nowadays with Guide, and also you have been an entrepreneur for a long time. So do you know any entrepreneur that actually got angel investment from an MBAN member?
I think the short answer is no one comes off to the top of my head, right? And I'm actually not sure why. I've heard of companies that they get investments from Nexia, for example, but I think MBAN as a network or collective, I have probably compared to next year, I probably heard a lot less. So I think that's a good thing for them to run the summit, right? And the turnout seems good. I think it's got like I had a few people who told me that they were coming to ASB where it was held, and that's where we're based. So it was good to know that the word is reaching out, right? But I guess the next thing is, what does each of these communities stand for, right? Because I think coming from my own experience and kind of speaking with a lot of the startups today, I think they're navigating kind of like a new frontier. There's a lot of well, I say this like people from my generation, like those who started companies in 2012, 13, 14, 15. And a lot of these are now second time founders. But I think that we see a lot of still the younger first time founders kind of like going through the same journeys that we've gone through. And in my perspective, like any angel network or collective should aim to kind of like reduce that the time for new founders to bridge a lot of these challenges.
Yes,
right?
it's funny you say that you've not seen, you've not heard of anyone actually who's received MBAN funding, because having spent most of my career at the later stages of the investment cycle, I always assume MBAN was this like very exclusive club where deals get syndicated and deals get done. It's very, very private network, and we know I personally know not just of MBAN, but I know of several other kind of these entrepreneur clubs and so on. And there's a level of maybe opacity, opaqueness attached to it. And I always assume that there's always deals always being done on the side that they don't get advertised, they don't get spoken of because of the nature of angel investing. So I mean, I can't comment on the quantity or quality of deals being done, but I always and I hope that deals are being in that space, because we really need those deals to be done so that when we get further down the funnel where I was, we can see more of this deal flow. And
well, the good news is that in the introduction of the summit, MBAN themselves actually bragged about the deal flow that they have facilitated. So they basically said that in the last 6 years, there was 117 deals amounting to $77 million. So there is deals, but they also have 350 members, right? So basically, if you just do a bit of math, you'll find out that 117 deals over 6 years is actually barely 20 deals a year. So 20 deals out of 350 members, it means that there is like less than 6% actively investing. And that's actually quite strange, because, I mean, now we have actually dug into the first session, which is the introduction by the president of MBAN. He basically says that the role of an angel investor is to fill the gap so that the idea stage can reach VCs, right? Then the second one is valuable mentorship. So basically cutting the trial and error, the learning curve, the time for the entrepreneur until they can achieve product market fit or their idea comes to reality. And then number 3 was connections. By the way, what do you think of the statistics? So 117 deals in 6 years out of 350 members. Does that sound like okay to you, or what do you think?
well, I always go by the 2% rule. So, and the VC and the PE stage, 2% of deals like walking through the door finally get executed, right? So if you're talking 177 over 6 years, then 2% of that is 4 deals, right? So if 4 deals come out the door, that means for us at later stage, there's
Hardly anything, right?
Yeah.
Because actually I noticed some things. So actually the first session was by the current president of MBAN, Peter Wee. By the way, I really enjoyed this session, and I also highly respect that individual because I also know his track record and so on. And he's also a very, very charismatic and funny character. So he always gives a good performance. But basically, his presentation showed a picture of a Jamaican runner in the 2012 Olympics. And then he asked, does anyone know this guy? And everyone was like, okay, he's wearing like Jamaica t-shirt and everything. So kind of assumed that he was on the same, team as Usain Bolt. So he said, you all know Usain Bolt, right? Yes, everybody knew, but nobody knew that guy. And then the next picture was actually 4 guys, including the guy we don't know, as well as Usain. And those 4 guys holding a gold medal. So they actually, as a relay team, they actually broke the world record in the 2012 Olympics. And the guy that none of us knew was actually the first runner. So if he didn't run well, probably Usain Bolt wouldn't have finished and they wouldn't have broke the world record. So what he was trying to say was that that is the role of angel investors. We run first so that later on VCs and private equity and IPOs and exits can happen. And I think that that is really, really excellent. But if I actually look at some of the numbers from the last 6 years, I'm shocked because from 2019 until 2021, 2019, early stage investing, this is tracked by MBAN itself. So early stage investing 2019 was $2.82 million. 2020, it grew to 7.74, so it's more than doubled. And then it almost doubled again from 2020 to 2021. So basically we grew from 2.82 all the way to 13 million in 3 years. Great, amazing. And mind you, that was COVID time, right? So the world was on fire, but still early stage investing was happening. Everything was great. And then suddenly 2022, it dropped, 2023 dropped, and 2024 dropped 3 years in a row, basically reverting not even to where it started, below where it started. So my comment about that analogy is that I think the first runner in our ecosystem have somehow mistaken themselves for the referee. I see so many events where angels want to judge startups. They are always telling startups and entrepreneurs how they should think, what kind of returns they deserve as investors and so on. But they are hardly playing their role in the ecosystem. You're not running well as a first runner, yet you are somehow waiting for the second runner, third runner, and the finisher. So that didn't make any sense to me by the same analogy that the president himself has presented. So what do you think about that?
So, I mean,
and I'm trying to be very diplomatic here, but
so I understand your concerns and I know where you're coming from. I would first I want to understand the data a bit more as well. I want to know what happened in those COVID years, because as we all know, COVID, everyone's sitting at home, everyone's maybe sitting on a pile of cash, everyone wants to just invest. We saw a lot of people at home sitting and going online to do stock trading and so on. So some of this money might have gone to that. Was that an anomaly, or was that reflective of a long-term trend, right?
Yeah. So here's a graph. So you can see this one is the early stage. This one is later stage.
Yeah.
So basically, later stage was actually flat during the COVID years.
Yeah.
But the early stage was growing. And then now, maybe this cohort have now, because they invested early stage, now they're investing late stage. So as you can see, late stage is still doing well.
So the funnel has come through, exactly.
But the next cohort never came.
It's true, yeah. So what this tells me is that it's kind of normalized to pre-COVID levels. So which makes me want to understand whether it was a COVID anomaly, and this is actually the kind of correct appetite for angel investing amongst Malaysians investors, or is it a genuine dip? If it is a genuine dip, as you are alluding to, then it is worrying for the future deal flow, and also obviously very frustrating for entrepreneurs.
Sure.
Yeah.
Okay. Now let's talk about again. You have anything to share about this? Okay. So if we go to the next point. Of the president of MBAN, what is the impact of MBAN according to them? So the impact of MBAN is to spread education and awareness, facilitate deal flow, and then influence policies related to, I guess, the startup ecosystem. So looking at some of the MBAN events, like even one that was hosted in the summit itself, Enter the Tiger's Lair, I actually participated in that in 2022. I actually won first prize. And you don't actually get any money, you don't get anything. The only thing that they promise you if you win is that so many of those angels that are sitting, right? Because you won and the judges, gave you their vote. So somehow there is consensus that you have a good potential. So what's supposed to happen is that, angel investors start conversations with you that may or may not lead to funding. Funding is one thing, but learning and feedback is a different thing.
Yep.
So basically, I've been here in this ecosystem for 6 years. I didn't see much coming from the education awareness that is helping the entrepreneur side of things. Maybe they are active in educating and and spreading awareness among angel investors. So maybe angel investors are curious about the startup ecosystem. So they want to see what are the new ideas that are being pursued, what is the state of the startup ecosystem, so that they maybe can make decisions about their current portfolios, or should they exit, they double down, or whatever. But what do you think? Do you think that is happening?
I think like the education of the investors, like from a portfolio allocation, I think that probably falls within the role of what MBAN is supposed or set up to do, right? Like educating the angels about what's prominent new technologies, what are prominent new trends, and potentially how they could help or be a part of this new trend, right? I think the role of an angel, I think that's where things can get a bit muddier, right? And this is something I've learned.
Do we all agree on the definition of an angel investor, by the way? Do you have a definition?
I think, okay, as far as a definition goes, right? Like, my thinking is around the purpose of an angel investor, right? Obviously, it's a source of capital, one, right? But why would you take money from an angel versus family, for example? Then the next question is that role that this angel is supposed to play. And in my mind, an angel who writes the first check to validate their company, that somebody who has experience running a business or being very successful with a corporate career and so on. There is a single role within a startup's life. And I think what you brought up earlier about Carousell founders' advice, right? Never run out of cash. The role of an angel is to bring companies closer to cash. When I say closer to cash, means revenue or new sources of capital, right? If you're not helping a company get closer to cash, what worth is your capital compared to my friend or my family, my mom and dad, and so on, right? Like, I think there's that in my mind, that distinctive purpose of why you are going to invest money in this company, perhaps in somebody that you may not have seen or known in your life before this, and suddenly you're this fan of this company. I don't think it's purely just out of financial return, but neither should it be purely out of charity. But when you can marry that purpose together, right? I think that's probably what's missing. And I've seen like some conversations with angels who go in a very different tangent, where it's just like, okay, what are you doing? Like, how am I going to make my money? What kind of percentage am I getting? What kind of rights and controls and so on? It very quickly dives into that. But getting closer to cash is where I think the focus should be.
And to answer your question, like, what's the definition of an angel, right? So, I mean, there are obviously textbook definitions. Generally, we're talking about high net worth individuals, right? These people will have access to, bankers' reports. They might be a private bank client and so on. So, our question: to what extent do they need to actually be more educated about a certain sector at an MBAN forum, for example? I think the value of an MBAN forum is when they actually bring capital and mentorship. And
so they are one of the smartest money around, basically.
Yeah. Correct. Yeah,
because they're close to the entrepreneur and it's very early.
Yeah. So I would argue that the focus or the main value that people get is not necessarily education. You get exposure on both sides to these companies, but there has to be an ultimate aim of actually deploying capital. It's an angel investor number. If you're not investing, then it's not really performing its function, right?
So you think that that 6% active investing in the last year is low, or is it acceptable for a 350 member group?
Okay, so I mean, investing obviously is I'm very diplomatic here. Investing is obviously very personal, and there has to be the right chemistry and so on, right? I mean, and it would be nice to see a lot more transactions happening for sure, especially at the angel stage. And I think that's what that's what needs to happen more in the Malaysian ecosystem, more and in institutions like MBAN, but also platforms. Your ACF platforms, B2B platforms need to actively bring together people who want capital and people who need capital and mentorship.
But I think ECF is more about retail investors participating,
correct. Yeah.
right? So what if I tell you, this is according to MBAN, that 36% of ECF funding in Malaysia is actually done by MBAN members. So these are the people who are supposed to be smart money. They're supposed to work with the entrepreneur to give cash plus mentorship, just copying out and saying, okay, forget it. I'm just going to put the money through ECF and then sit and watch my money grow. No mentorship, no intimacy, no education.
Well, that's the equivalent of MBAN actually coming together the pool fund and then everyone just putting into blind pool, right? And yeah, back to the point, the value of MBAN is the one-on-one connections.
Yeah.
And it's very important to facilitate this. And I think in a way also facilitate deals to actually happen rather than necessarily just bringing everyone in a room or having a pitch, for example.
Okay, yeah, go ahead.
Sorry, but I think that's an interesting stat as well, right? Like, it would be interesting to see, like, based on the proportion or based on the percentage of people from the MBAN network that are investing, and what's that percentage like? So if you're talking about like 350 members and what was it, 17%?
117 deals in the last 6 years.
And an active 6% active investors.
Yes, yeah.
Right?
So it's 20 deals a year, and 20 out of 350 is 6%.
Correct. And I would probably, because of the check sizes as well, right? Like I think.
Yeah, they consider angel investment starting from 5,000 ringgit.
And that's probably the same as the ECF round. So I think the ECF could go as low as 1,000 ringgit. But that participation rate, I think benchmarking against what an ECF active members versus the total population of people who have accounts with Pitch In, for example, or any ECF platform. What's that participation rate? I think that would be a very interesting stat to benchmark against, right? Because if you're talking like if the retail participation of people who have accounts and then are willing to put money where their mouth is, and if that participation rate is higher than 6% or whatever that MBAN number is, I think that's going to be a very questionable benchmark to kind of draw some relation with. That means your retail are taking more risk.
Exactly.
Yeah.
And that doesn't make sense, right?
Yeah, but it's two parties to the equation, right? And like entrepreneurs as well. They, I think, one of my observations in sitting across from entrepreneurs is how are they crafting the pitch? How are they telling the story? How are they kind of packaging the company, and what level of readiness they are to actually talk to investors, go through the arduous process of taking investment, and also willing to be mentored, willing to partner as well. And people like yourselves, you know the game, right?
I've been doing it 20 years. So
Exactly, yeah. So I can tell you, having seen, so the other 98%, I would say, a large portion of that, people who maybe don't know the game, right? And they come to table as well. So I think entrepreneurs as well need to.
They come to which table? The VCs or the Dana Impacts, or which table?
So
or angels?
I can only talk about the people who come to opposite me. So the VC and the PE
so
stage.
that's the later stage.
It's the later stage.
But the point here is that actually, if angel investors were doing their part, those people coming to you would have been much more polished. That's my point. Great, we agree on this one. Okay. So let's go to the next one. So the next segment was about secondary market for unlisted shares. So the co-founder of Pitch In went up, talked about their secondary shares platform, which I think is actually excellent. Maybe the only thing that I don't like about it, which is actually not up to them, it's up to the SC, is the fact that you can only list your secondary shares if you have already done an ECF. So it's not open for any company. So that is a kind of a prerequisite, and you need to wait 6 months after the ECF to list your secondary shares. So he basically spoke about, in the pipeline, the SC may allow them to actually also trade secondary shares from all companies, in which case that would really, really be beneficial. So do you think that now that there is a path to some kind of exit, like for example, we heard like some were on stage, and we're going to cover them in the right segment later, but the only way he got an exit was because he actually sold on secondary. So now, do you think that people will rush to early stage investing because they know they can exit somehow?
I think it's a very good move and that's the direction that the market in general needs to move in, right? Unlisted shares need liquidity, and in the same way that the funds also need liquidity. So all this kind of has an add-on effect. One of the big issues we had in the fund management industry is lack of exits in Malaysia and also Southeast Asia.
Capital needs to be recycled into new, right?
Yes, correct. And everyone wants to move along. So this is a very good development in my opinion, and I think it's a good kind of evolution in the whole ecosystem, ECF, P2P, or the various platforms. We've had that stage of kind of establishing and educating the market, and then now people are more comfortable. People know the kind of level of assurance that you have on this level, and now you gradually open up. So I think it's also good that we're doing it in this phased approach.
So I actually like it, but maybe what I want to ask you, Alvin, what do you think? So basically putting yourself in the entrepreneur's shoes, how would you feel while you're busy building your startup? You have your early investors, maybe they've been around for a few years already on your cap table. Now they want to exit, and there is money changing hands, but basically none of it is coming to you. None of it is coming to grow the company. It's just that you're replacing one guy who tells you what to do with another guy who tells you what to do, except that the new guy, maybe you don't have a many years of relationship with. So how is that from an entrepreneur's perspective?
So I've actually done the secondaries transaction before, and this was because the team that funded our pre-seed rounds, when they reached our Series A, they intimated to us that if you're going to raise a new round after this, we would like to be we would like to put forth our stake to be sold, right? So I've seen secondary transactions being done, and you're right in the sense like when you're doing fundraising, you're really trying to market the company. You're really trying to push forward the agenda that this is a very solid business, and you build the foundations of it. And especially when we were raising our Series B, we felt that way, right? And then you have an investor who's also on your board trying to knock on your door and say, hey, remember us? Remember these guys who funded you right from the very beginning? I think it's time for us to cash out because our fund is coming to the end of its life, and so on and so forth. There was obviously friction trying to kind of position a fundraise alongside an early investor who also wants to exit at what, in most people's view, still an early stage company, right? Then there were two mitigating factors, at least from my point of view, and this was a factor of how we decided what game we would play, and we wanted to be in control of it. And what I mean by that is we kind of knew what our stage of exit was going to be. We kind of knew what the valuations of our exit was going to be. So we entertained the idea, but didn't give it an exclusive priority, right? So and I'll give you the practical thing of what we did. We actually tranched out our Series B round so that it closed a primary round, and then the secondary round was when the secondary transaction was also being put into. So there was a total allocation of what the round was going to be. We closed the first primary part of it, which is about 60 or 70% of the round size. And then the secondaries was kind of like packaged out together with the remaining 30% of the allocation. So that's like the practical part of it. But I do think from an entrepreneur's perspective, you want, the default thinking is you want people to ride with you all the way to the end. You don't want to carry passengers and then drop them off at different bus stations. But I think the reality is that if you're going to take an extremely long time, and our investors at that time had been with us for about 6 years or 5 years, right? And we were obviously not the first investment, right? And that meant that they had an obligation to their investors as well. But yeah, I think what we've learned during that time as well, when we were looking at comparables of other companies in our stage and how long it takes from C to Series B and then Series B to IPO, and the data was trending towards companies taking longer and longer towards an IPO route or longer and longer towards an exit route, which by default means you're gonna have to let off some passengers along the way, right? Facebook took 8 years to IPO, which was in Silicon Valley terms a really long time, right? Because at the beginning of VC, there weren't, not all funds were like 10-year funds. They were like 5+2. And the fact that Facebook took 8 years to IPO was like, hey, what's going on, right? And that was kind of like the general trend. And I think that trend will persist. I think it's having a, on the other hand, right, having a healthy secondary market puts entrepreneurs in some pressure where we need our governance to be at the level where a secondary transaction can take place, right? And I think hand on heart, no entrepreneur will say that at seed or at Series A that we have the best processes in the world, right? But I think having a secondary market that people would kind of like peek and look at what's under the hood every now and then, I think keeps a lot of entrepreneurs on toes. And I think I think it looks like a net benefit towards everyone playing, a fair game, being more aware of like, okay, I'm planning a next round. I know who the universe of investors are. I know who I would like to come in and join me. If I'm going to let off a passenger at one of the bus stations, I want to decide who I want to pick up from there as well. Right. So I think it as a net benefit, I think it's good.
I think it's important for entrepreneurs also to have this. It's like an outlet valve, right? Because if you're going to have a VC at your cap table, you need to go in knowing that they have an exit plan, and if they don't have this exit valve, they're going to behave in very weird ways. Let's say they're going to put a lot of pressure on you to do something maybe that you're not ready to do in terms of next fundraise, exits, and so on, right? So for the entrepreneur, knowing that this option is there, I think entrepreneurs should see that as a good thing. If you want to welcome institutional capital to your cap table, this is part of the game, right? And have that processes in and so on, and you're practicing for later as well, right?
But I think good governance is part of the intention of it, right? Like I think there won't be a healthy secondary market if nobody files their audits on time. Nobody has their management accounts on time.
Correct. Yeah, that's hygiene.
Yeah,
I think
basic hygiene.
But again, like we are still talking about it from the point of investors have to exit. They have their fund horizon or whatever. But actually, have you ever thought that maybe someone would buy secondary shares of my company, and then let's say they don't agree with my direction. Let's say the old investor, for example, we have an understanding that we are B2B focused, but for example, the entity that buys the secondary shares thinks that we should be B2C focused. And now suddenly, I have to have, these kinds of conversations with someone. I mean, it wasn't part of the deal. We've been running it for many years. Now suddenly someone is coming and has an opinion, and I can't get rid of them because they are on the cap table.
So I always say like startups, probably if the founders themselves are not like business trained or come from a strong corporate background, you probably need like either a good finance or a good lawyer, right? Because a lot of that that's going to be part of like business structuring as well, right? If you're going to welcome in a new investor, you like I said, you want to choose the passengers you pick up along your journey. And
Do you have any say if a secondary is happening as an entrepreneur? No, right?
technically, you should have provisions within your
Only right of
your
first
share.
refusal. So of course, if you want to buy, but how many entrepreneurs have money to buy before the?
Yep. So I think this is where it's the strength of the relationships as well, right? Like with your current cap table, if somebody wants to exit, you want to know who you're exiting to, and it's a matter for the company to also be decisive in that manner. And kind of that. So I can share, for example, we had a situation before where the existing owner of the shares had a board seat, and then when they wanted to sell it, the incoming expects to keep the board seat, right? And whether it's through the use of a good lawyer or a good CFO, you try to negotiate that away if you think that you not yet have that familiarity with this incoming investor. And it's usually, so it's part of doing business. I call this kind of like this hazard of doing business, right? It's part of the cost of it.
But you said negotiate, which implies that you do have some kind of leverage. But what if it actually happens against your will? So you try to negotiate, but then the one who's exiting says, "Look, man, my fund has reached the end of its time. I really need the money. I know you don't like it, but I have to do it." And then the new guy comes, and or is that?
There is.
Do you have a way to stop it if that's happening?
I don't think there is a clear way to say that no, you cannot sell to party X, right? But
But can I block their board seat?
Yes,
They can sell, but I can block the board
you
seat
can
somehow.
So that's
If
why
I control the board, then I guess I
exactly.
can stop it. Okay.
So that's why your board membership usually it's not even numbers, right? You need an odd number.
And the founders need to control it. By the way, Marcus Tan of Carousell still control the board, even though as founders, of course, their share is a minority now, but they still control the board.
That would be one of the mechanisms for it, right? You kind of defend your turf by saying, look, I'm going to shoot it down at the board level. And it then needs to be a proper justification, which comes back again to knowing your business well enough, having that hygiene in place, knowing metrics at the tip of your fingers, right? And therefore knowing also anticipating this kind of scenarios in advance, right? And this is more of like a VC scenario, right? But if we're talking about like secondary transactions, which maybe involve like retail selling to other retail within an ECF, I think then that's a different problem there, right? But from a strategic level, where somebody who's owning a chunk of your shares, like 10 to 15%, trying to sell, I think that's a big deal. I think that's a deal that should be very carefully deliberated at the board level. And as much as it is a distraction to running the business, I think it is part of the cost of what you need to do as an entrepreneur.
But also, I think we should be conscious about what we're talking about here. Like a VC, for example, won't necessarily put their secondary trade on an ECF platform, right? Because where we started this conversation was the ECF
No,
platform.
actually, we heard one case where he made a 400x return. It's actually the next segment. So
Okay,
we were
alright,
going
okay,
into that
okay,
anyway.
yep.
Okay, so the next segment was, can angels make 20x return on their investment? And this was actually one of the most enjoyable panels because it had two past presidents of MBAN on stage, plus a new member who's a female. And then they were interviewed by a TV personality, a host from TV. Okay, so my impression was, okay, let's go back to the 6 years that we're talking about, right? So we had an immediate past president who basically, during his term, we saw the decline in early stage investing. And then the president before him, where we actually saw the boom from 2019 to 2021. And I'm really not saying this because Doc Siva is on my cap table, he's the founder of the collective, but really actually is the numbers that show that. So I've worked with Doc Siva for a number of years. He was actually the first institutional money that came into my company. He has actually coached like thousands of entrepreneurs. So he's been an entrepreneur himself for 40 years, and he's been coaching entrepreneurs for decades. And I know that he doesn't do it just for the 20x return. Not to say that he doesn't want 20x return. In fact, he shared on stage that he got a 20x return and he was happy. He said, I made 10x, I made 20x, but I also lost on some of my investments. But the investments that actually succeeded ended up paying for everything that I've invested. So I'm actually a happy camper. On the other hand, we had another panelist who actually said that he made 400x return by selling on secondaries recently. And then he said, I'm surprised that we're only talking about 20x because in my book, 20x should be the minimum that we chase for as angel investors. So let me first get your opinions on that statement. Should 20x be, what our ambition, or should that be the minimum that we should expect, or they should expect as angel investors?
One before I answer that,
Okay.
I think I recall one comment that he made was both instances were share buybacks from the founder.
Yes.
Yeah.
Yes.
So I think that makes it an even more unique kind of situation. So you can't really get 20x out there in the market, right?
So the founders have to buy back.
Yeah, and there was although there was a good relationship with the founders, and from they were in from day one, and so on in life circumstances. So
And he was very patient. He only had the conversation because of the capital gains was coming, right? So
Yeah.
So he wasn't necessarily pressuring them to exit, but he was like, "Hey guys, I really need to do it now, otherwise I'll pay capital gains."
Yeah. So to me, the main takeaway of that is that it just highlights the nature of VC investing, right? You're gonna have to have a large portfolio, and your portfolio is gonna be carried by one or two large investments. You're gonna make a whole bunch of losses, and I wouldn't get too fixated on are you gonna make 20x? What number are you gonna make? I think the 20x sounds like a nice headline for a panel, or but in reality, even the panelists admit, do you see it in real life? I mean, not really.
So in your book, IRR is actually the name of the game, right? That's how you look at it from a portfolio point of view, not from a specific investment.
Yeah,
Right?
well, yeah, okay. So in the fund management industry, there's also a whole conversation about IRR versus money multiple. Actually, if we're talking about early stage investing, I think money multiple is the best number, because the long time horizons you're speaking of, even a 2x, it's only going to give you like a 7% IRR in a few years, right? So I think 20x is
Just a headline.
a headline.
Okay.
It reminds me of a highlight reel of sports, right? You commemorate this legend by showing a highlight reel of his greatest moments or her greatest moments, and that's all you see, right? Is the entire portfolio made up of the beautiful flicks, tricks, kicks, whatever that may be, right? And I think whether it's a question about portfolio allocation as well, right? Returning the size of the fund is probably one of the name of the games for VCs, for example. If I have a $60 million fund, all my bets need to return me $60 million or more, right? And what is the kind of valuations that they need to invest in? And there kind of two facets to it as well, right? Like if an entrepreneur lets somebody, I say this in the nicest way possible, makes 400x by being on a cap table. Like you said, maybe there's a great relationship there, but maybe he's also left money on the table. Right? By whether it's or not, he undervalued his business or what and so on, right? So I think that on the balance of things, right? From a portfolio allocation, if you're gonna set aside some money, right? There are multiple benchmarks of returns, and angels potentially taking what you say, running the first part of the relay, taking potentially the most risk. Maybe there is a different benchmark for that, and it could be a case where every dollar I put, hopefully it returns 20x because I'm so early in the game, right? And with the balance of failures and hits and misses, you come up with maybe a 3 to 5x portfolio return, right? And I think that's probably kind of like one of the ways to look at it.
Speaking of risk,
Yeah.
so the same angel investor who said that he made a 400x exit also said on the same panel that he meets around 2,000 startups a year and only invests in maximum 10. Incidentally, I was in 2019, 2 months into Earth, one of the 1,990 startups that he didn't invest in. And my issue was not that he didn't invest, because also Gobi, who later on invested, they actually also, because we were too early, rejected us at that stage, and they were like, okay, you need to continue, build the business, build the numbers, and then come back. But my issue was that because of my experience with that particular angel investor, the rejection was fine, but what wasn't fine was that I actually pitched my heart out, and then the rejection came with zero feedback. So I'm just wondering if MBAN and angel investing, MBAN according to them, they basically want to spread awareness, education, facilitate deal flow, and affect policy, which sounds to me like there is a bit of nation building baked into good returns. I'm wondering what happens when 1,990 startups get rejected with zero feedback. What happens to their early stage enthusiasm? How many of them don't pitch again because that was so painful? At that point, I was doing it for 15 years. So I'm accustomed to rejection. It's fine. You don't want to invest? Fine. But you need to give me feedback. You need to respect my time, and you need to respect my attempt. So I felt that there was a bit of lack of empathy there. It was said as a bit of a brag that, oh, we have such a high bar, high standards, we only invest in the best of the best. But maybe there is a different name for what you are doing. And in my book, it isn't angel investing. What do you think?
Oh, shots fired.
You knew it was coming.
Yeah. So to the point of, is it angel investing, or is it a different mode of investing? Is it your normal pre-seed in investing, right? So I mean, there is an kind of implication that if you're part of an angel network, there's an element of mentoring, and you even in institutional settings, we always like to give reasons for rejection, and people ask it, and it's part of national building. It's part of growing as an entrepreneur, and it's part of giving back and contributing to the ecosystem, right? People always talk about the value of death, and my anecdote is that the value of death always changes, depends on who you speak to, and it depends on who that person, at which stage that person got rejected. Right, so it's a lot. Some people say so at the beginning. Some people say it's Series B, Series C. It's where they died. They come to with a bitter experience, right? But again, at an institutional level, there's no lack of funding, right?
Yeah.
So, but it's the entrepreneurs. They need to know how to kind of progress through the stages, and what it will take for them to go to the next level, how they need to craft the story, how they need to approach investors at the right time before they run out of cash, for example. So I think all this feedback is definitely valuable to the entrepreneur, and I think that the value in an institution like MBAN and people like Doc Siva and Professio and all have taken on this mantle of actually and guide as well, mentoring the entrepreneurs and giving valuable, timely feedback, and then after that, obviously, it's the entrepreneur's job to kind of have the grit and go at it again, right? But it's interesting that you mentioned that zero feedback. I think feedback is very, very important, so people know how to improve.
It felt to me a bit like, the members of MBAN essentially adopted this ethos from 2021 to 2023, and that's why early stage investing dropped also from 13 million down back to like 3 point something million. So if that's how it is, then definitely this is the result, in my opinion. Okay,
But-
Alvin, what do you think?
But to your point, right? Like somebody who's looking after a 400x return, probably that is the numbers that you need to go through, right? Like 2,000 companies a year to select 10, and then with such a rigorous process, they probably may not have time for feedback. But it points back.
But
to
should
the
you call
purpose,
yourself
right?
angel investor then, and be the president of MBAN?
So that's where we're talking about the purpose of it, right? I think all is fair in the world, right?
Yeah. He
Right.
has the right to do it.
Yeah.
But I'm just saying that
So-
is this what entrepreneurs deserve?
I think the segmentation of angels, it's probably not been kind of like properly done yet, and I'm sure there's like a proper way to do it. But if you see like the VC and the later stage investors, I think there's a clear segmentation between what mid-market Ps do versus what a buyout fund versus all these different things, right? And it's quite over the years been quite well defined what roles these different investors play. So there are certain investors that only do C to Series A. There are certain investors that only do A, B rounds. There are certain investors that say, no, since everything's de-risk, I like to do pre-IPO deals, right? And it's been very well segmented to some extent. I don't feel that there is an easy way to segment angel investors in the way that you put it, right? So somebody who's looking for a 400x return on every investment does probably need to meet 2,000 companies and invest 10, right? And if that's going to be classed as angel investor and somebody who's kind of like, hey, I'm happy to do a deal at day one, exit at Series A, make 5x, I'm happy because none of my current portfolio allocation and the time available to me can already give me a 5x return over a 3 to 5 year
Shorter
period,
time, yeah.
right? So I think that segmentation, whether or not it can or should be done, it comes back to what we talked about earlier about the purpose of it, right? What is the reason for existence of MBAN, for example? What's the reason of existence for Nexia and anyone else? right?
Who's your
Yeah.
duty of care to? Like, if you're an institution like me, I have a duty of care, then I have a very clear reason for rejection, right? But yeah, I mean, to maybe to expand on your point, if you're part of the angel network, then you don't have an institutional duty of care, but you're doing it for a certain reason, and you're some ecosystem building and so on, and that I think involves in giving honest, timely feedback. Would be helpful.
Actually, what struck me most is the fact that it's fine to have such a high bar, but at the same time, he also said that he tries to be there first, meaning that branding wise, he wants any new entrepreneur that is thinking of doing a startup to talk to him first, which is good. I think it's good, but you have to give them feedback, because if you are becoming, right, the gatekeeper to the startup ecosystem, then I think you have a role beyond just okay, I only mentored the 10 that I invested, and then the other 1,990 can go and cry elsewhere, basically. So my point was just about that. It seems that the stated goal is to be the first one, the top of mind to new entrepreneurs. So in my book, that comes with additional responsibility. That just imagine like Google, right? So we go to Google and then we write the search word, and then it opens up the door to elsewhere. So imagine if Google, starts to block, 1990 websites and only show you 10. You would have an issue with that, right? So no benefit to those websites. Only the 10 that Google prefer are the ones who get the benefit, i.e. the traffic. But all those other 1,190 get nothing. So I think there was be an inherent problem there.
I think that still comes back to the point, right? Like as a collective, as a network, is that thinking process in terms of the returns something that's pervasive across the entire network, And to me, if you're investing your own money, you should make your own decisions, right? So the other 300 members, I mean, are they available to be pitched to as well, right? So for somebody who has a high bar, right, and they may tell you, look, I don't like you, thanks, move on, right? My question would be like, what about the other 300 plus members?
Good point.
Like,
Good point.
how do you position yourself, and what makes sense to you? Would a 3x return over 3 years make sense?
I think
for example,
I think at
okay.
that stage when you have an idea, I think thinking of how many X when you haven't even achieved product market fit, you don't even know your TAM or whatever.
It's a paper.
It's just it doesn't make any sense.
Exactly.
But actually, just to the point of the 350 members, what is the role of the 350 members? I think that MBAN already has the classification of accredited angel investor and non-accredited, and the only implication of that is that who can claim tax incentive or not, and that's fine. But there isn't any entrepreneur-facing metric that tells me whether I'm sitting across the table from one of the 94 never invested, inactive members, observer members, or I'm sitting in front of the 6% who invest on an annual basis. So I think that MBAN owes it to entrepreneurs to at least give us a profile. I don't want to know what he invested in. I don't want to know how much he invested, but at least give me, sort of a profile of, is this guy an observer or is this guy an active investor over the last 12 months, so that at least I know whether it's worth to invest my time or not. Because sometimes we don't even get feedback. So at least we need to filter out the ones that are never going to invest, but they're always going to be there to hear your ideas, and then maybe they have invested in other companies in the same category, so there is a bit of data mining happening and so on. And some of that, by the way, is not just happening inside Malaysia. So we also saw a wave of external investors over the last 12 months that are doing like very aggressive data mining. So they come here very enthusiastic, they talk to everybody, and then they ask, even so much to ask like data room from everybody. I didn't, for example, give access unless I have a like a term sheet or a very serious conversation. I wouldn't give access to data room, but I have been asked for data room even on the first or second conversation with some investors. So that is clear sort of a data mining attempt, and I think entrepreneurs need to be aware of that. And one of the ways to at least filter who you're talking to is, did they invest at least 5,000 ringgit according to their own definition? Did the guy in front of me invest at least 5,000 ringgit in a startup in the last 12 months? Is that fair ask, or is that too much?
Yeah, I think that's fair. Like we always, when we talk about due diligence, it's always the investor doing due diligence on the founding team and the company and so on. And I think like more and more sophisticated founders are doing the reverse as well, right? Like, so if you want to invest, like tell me, what are your other investments that you've made, right? I think that's a very fair question to ask. You would do similarly informal background checks, like talk to the portfolio companies, talk to somebody who knows this person, right? And I think that's definitely fair. There are direct ways to do it. There are indirect ways to do it. And I think there's no kind of like clear solution for the whole segmentation and getting to know each other. I think it's the strength of your network, the grittiness, like what we talk about, being wanting to take that active step, an active approach. It is and can be time consuming. And I come back to the point, right? It's a bit of hazard of doing business, right? If you're an entrepreneur, like, these are some of the things that you figure out along the way. But I think it's 100% a fair ask to grill the investors as part of your own due diligence. Do I want this person in? Do I want to take counsel from this person? If I ever do I want this person as a board member? Right? Can I count on this person to open new doors for me? Right? Again, back to my point, I like about investors is that if they can bring you closer to cash, I think that's a very, very strong point. So on top of how good you are, have you helped other people fundraise before? Can you help me fundraise the next round? Can I count on you for advice, right? And I've been very, very lucky to have people on my cap table before who sat with me as I was pitching to new investors, because I was still learning. And I'm very grateful for those kind of support. I've been really blessed. But it's also fair to say that not everyone has that kind of support, right? But if you've gone through that kind of hell, maybe you wisen up. But there's no real easy way to just kind of like segment who are the right kinds of investors at that stage. I think with VCs in general, you can look at the track record. You can do a lot more due diligence. I think on an individual angel, it's probably hard.
I really empathize with entrepreneurs, right? One of the things that when I was in my previous role, we spoke to a lot of ecosystem players and asked what are the main challenges. And there's an endless series of these Shark Tanks, Tigers, Lairs, accelerator programs, so on, but very little promise of capital at the end of it, which is also how and why we designed a lot of the things that we did during my time there with the actual allocation, because like I said, fast to cash, right? You want the money. So I think there's two sides. There's 2 points I want to make. One, when you see the particular rise in those early years, and then you see it normalizing, and as I pointed out earlier, it normalized back to 2019. Is it maybe a function of an exceptional work done by particular someone, but above a baseline? So are we returning to an old baseline? So was that the kind of exception? That's the question to be asked. And also secondly, members of the MBAN as well, are they you see passive sitting on the sideline as well? Not everyone has the bandwidth capacity to take maybe that active.
5,000 ringgit is the minimum.
Yeah.
They don't have 5,000 ringgit to invest in a startup once a year. I think that's a very low bar. So interesting point, actually, you make it about, is this a COVID, because of COVID or because of printing money or something like that. And then after that, interest rate went up. So, money became scarce and now everybody's enjoying, nice, juicy 5% in the bank. So why should I put my money in harm's way? But we're talking about people who are chasing, 20x returns up to even 400x returns. So do you think those kinds of people would actually be discouraged from early stage investing because they get 5% at the bank?
I love the thing from an allocator's mind.
I know, right? So how do I phrase it? Let's try to put this on. So, okay, I think a lot of the things that happened in the COVID era was exceptional, right? People sit at home, they got nothing else to do with their time and money, and so on. And now people have, interest rates have gone up. You're right. You have your 5%. Your opportunity cost of investing is higher. The time that you can allocate to look at and evaluate investments is less
limited.
Yeah. People are back to their day jobs. There's a there's also other players which have also come into the ecosystem, right? So a lot of entrepreneurs maybe going through things like boot camps or venture builds and so on. So there's a more kind of structured paths for pre-seed for early stage companies, for day zero kind of investors come in as well, and that happened in 2023, right? So that there's a few factors, and obviously no one's actually quantified what's happening in stage, but maybe we should add that bar as well. How much money came to pre-seed investing from those venture builds?
No, but actually, if you actually come to think of it, day zero actually should not be reflected here, because day zero don't even have an idea. They're not an early stage investment yet. They're still trying to find co-founder, still trying to think what idea to pursue. So
I'm still thinking my investor allocator hat where I just want to see the funnel going going through. So yeah, I'm thinking from
actually the way I see it, when you get the Antlers of the world and you get all of those like very 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 early stage day zero efforts, this should actually spur even faster growth in early stage investing, not less actually, because they come out of Antler, then they need early stage investing, and now they are even crystallized the idea, found a co-founder in a more polished form, right? So it would actually be weird that Antler in 2 cohorts already lapped MBAN annual deal flow in 2 cohorts. And that's weird, because that's just one player, newcomer into the market, and MBAN has been around, I don't know for how long, but a long time, and there are 350 angels, and I think it is just a bit of underperformance, or to put it lightly, that they get lapped by a newcomer in 2 cohorts.
So one thing I would say about Antler as well, they plugged in their graduates. So say the people go through their cohort into their own fundraising cycle, right? So people, if you've gone through the Antler bootcamp, you would then be exposed to a whole new host of like global investors and so on. So you wouldn't then be pitching to that to the MBAN, because your pool is much wider. You've already gotten the mentorship. You've already gotten all of that. So right. you wouldn't go to you wouldn't pitch for that. But you see that then it will contribute to this next the column in the bar graph.
But you don't think that this high bar in 2023 in the later stage investing is the cohort from earlier graduating into the later stage?
Actually, it is. It definitely is. That's an knock-on effect, and yes, I do worry for the following years. Mm-hmm. You've kind of switched off the tap.
Okay, so let's move to the next segment. The next segment was about the deep tech gold mine. So the speaker was the vice chairman of MBAN Penang, and basically he was talking about semiconductors, how there is so much happening in that space, how there is innovation. Penang is great. There's a lot of startups in Penang that want to get funded. But then later on, in one of the other segments, someone said, well, actually, we've been to Penang. The Penang entrepreneurs don't want to take our money. But they have their own ecosystem, their own funders. They're mainly family offices who are in it for the long term. So, this segment felt a bit like, and by the way, I really liked the summit. I think it was very well put together. I really enjoyed my time there. But I think that this segment was put there as a filler, maybe for political correctness, or I don't know what was the objective. But for example, it was weird that I listened to this for almost exactly the same amount of time that I listened to Carousell founder, and that one would have been much more meaningful. This is just kind of pitching one area, one ecosystem to the audience. So actually, I looked around in the auditorium, and actually half the seats were empty during this segment. So maybe that is feedback for the organizers that, sure, I'm not saying take it out, but I'm just saying that just give it the proper allocation, because it didn't seem like that was interesting to the participants because so many of them left the room. Did you attend this one?
I walked out for part of it, but that's because it was just before my section.
Oh, so right. So you were preparing. Yeah. Okay. Yeah. Never mind. So you don't want to, you didn't attend, so I won't ask you what you thought about it. But basically, yeah, it was just very deep into the Penang ecosystem. The next one, the untapped potential of homegrown startups. So there we had like Sarawak development, the equivalent of MDEC in Sarawak. Then we had, we had Cradle. Then we also had Digital Penang. And then it was moderated by Zelia. By the way, Zelia, of course, is part of Scale Up Malaysia, who gave me my first external capital into Earth. And I actually think that now she's in Pitchin. So I actually enjoyed this, but basically I felt that I was just hearing a lot of the same things. Official narrative, just everybody, kind of telling it from their point of view. Maybe there wasn't so much of what is actually the point. So maybe, is it just raising the flag? Is it just to have Sarawak represented, or are you trying to actually pull some entrepreneurs to go and open shop in Sarawak? I actually didn't know what was the point of that segment, for example. Then Cradle, okay, of course, everybody goes to Cradle, to get the first funding or whatever. Which, by the way, later on in one of the other segments, someone said, okay, there's no street cred of government grants, right? So don't come and brag about grants, because that we don't really care about that. And then of course Digital Penang was echoing the same thing in the earlier segment, so that was like more of the same. So what did you think of that segment?
Yeah.
Sorry, you wanted to say something. Go ahead. I don't want to cut his train of thought.
Yeah, no, suddenly no, you go ahead.
Did it go?
Did it good?
Sorry, man. So I was talking about Sarawak, like trying to.
Yeah, no. So I wanted to throw the question.
Oh,
Right?
okay.
Like, when we talk about homegrown startups, right? What exactly do we mean by homegrown startups? Right? Is it a made in Malaysia, for Malaysia? Must the founders be Malaysian? Like it always breeds a lot of these kind of questions when when we were trying to put a poster up and say you should do this or you should invest in this, and these narratives have like, oh, homegrown or organic, blah blah blah, right? That kind of stuff, right? So what exactly is homegrown? And I'll give an example of why I think that's important, right? Because like you rightly mentioned, everyone goes to Cradle, and we were no different before when we were raising a seed round.
But I didn't, by the way, because we don't have like the Malaysian component in our cap
Exactly,
table, so
right.
we don't qualify. Yeah.
So I think that was a question, right? Because we went through the hoops of trying to get not just a grant, an actual investment. This was back in the days when Cradle Seed Ventures was still investing, and we went through the hoops. We've painted who we are as a company, and the reality was even though the cap table consisted of already at that point a couple of VCs who are not based in Malaysia. The founder is a UK citizen, but is based in Malaysia. 99% of the team is based in Malaysia, and that ultimately it was decided that we were not a Malaysian startup, right? Because we didn't pass certain beneficial owners tests, sort of, right? But all the capital that we were raising was going to be funneled into Malaysia. A lot of the talents that we were acquiring were going to be in Malaysia, move to Malaysia. So there's going to be a mix of acquiring talent from overseas because we don't have them here. And then there is the component of like, enriching a lot of the folks that are already based here in KL. Right? So there's always this thing that, it sits at a corner of my mind and says like, look, it feels like we tick all the right boxes, right? And I don't want to say that we should get the money because we deserve it. I mean, there are a lot of other deserving startups as well. But when it comes to that particular question, what is a homegrown startup? I think it's always going to be a bitter pill to swallow when everything that we're doing to get money is going to be spent here, and then it feels like the money that we get from outside and spending it here is not real money, and I find that a little bit like what is the agenda here, right? So it's always a question that when I see posters like that or narratives like that, I do question underlying what's the theme of it, what's the.
So Omar, why do you think this panel existed? Is it just political correctness, or were they actually trying to achieve something? Pull entrepreneurs to Sarawak, pull entrepreneurs to Penang, or what was the objective?
Yeah, so I mean, I know of these guys very well, right? And I've done all our road shows at all of these locations as well, Sarawak, Penang, and obviously KL. We work with them very closely. They do a lot of good work, and in terms of showcasing startups, in terms of bringing people who are especially outside of KL into the KL sphere or ecosystem, and telling the story overseas. I can share with you the story when I did our roadshow in Sarawak, and it was held and organized by Cradle, and we went to the stack area. And a lot of Sarawakians came to us and said, we didn't know these things exist. Can we as Sarawakans apply for this kind of funding and so on. In a way, if you call it outreach work, that they do is very good outwards. But I guess to your question is what value did they bring in a session like this, right?
I understand Sarawakans can come here for funding and opportunities, but
Yep.
what is he trying to achieve from the audience?
So I think there are a lot of entrepreneurs who, yes, you can read a brochure or a pamphlet, but I notice a lot of people, when you actually see someone and you can actually relate to someone, then you know who to approach.
Approach for what actually? To move to open a branch in Sarawak, or what's actually achievable from an organization like SDEC for an entrepreneur?
I don't have any immediate answer to that question.
Because I would imagine that they can go to MDEC, they can go to Cradle, they can go to Dana Impact, there's just so much going on here, right? So I would understand them to open up opportunities for local entrepreneurs in Sarawak to basically, go national, go global by connecting to opportunities here. But what is the story for the other way around? That is what I was missing. And when I heard the panel, I didn't get it either. Anyway, that's fine. We can move on to the next one. That is actually the one where Omar was a panelist. So maybe I'll actually let you recap what was the panel about, what was the positions of the panelists, and is there something that you were on that panel and you didn't get a chance to say? Now is the opportunity to unpack that.
Yeah, sure. So the panel was about impact investing, and it was.
Thank you for the shout out, by the way.
Yeah. Yeah, and it's a new asset class. It's a new style of investing that's maybe not very well understood. So we spent a bit of time to kind of define what it is, how does it differ from other types of investing, your normal VC and PE, and how you go about kind of measuring impact and what does it mean, right? It's a very good panel. Renuka was the moderator, it's about Scale Up Profesio. We had Saikit, head of MVCA, and partner Artem, and we had Melissa as well, who's now recently started her own impact fund.
She was very tough, right?
Right? and I know Melissa very well as well. She ran an NGO called Impact Circle, which we work very closely with. When we ran our Impact Challenge, and we do a lot of food and agri investment. So during that session, we spent a lot of time and defining what impact investing is and how is it different from normal investing, and it comes back to the double bottom line, right? So you have to be making money, obviously, because no one in investing wants to lose money. That's the definition of investing. But you also have to be doing good, and what does it mean to be doing good, right? So then, I spoke a bit about the kind of management frameworks that are out there, impact management framework, and so on. Give examples about a very good company that we invested in before, called Earth. You might know about it, Mo.
Just a little bit.
Yeah. And how and we talked about how to apply the impact framework to investment such as Earth, right? You have to have your theory of change.
By the way, that was the first time I've heard it. I didn't know about IMP5. When I later on started to research about it after I heard you, and then I was like, oh, okay, so this is what they were actually evaluating. Because from where I was standing, we were just meeting team after team, from Dana Impact, and having different conversations. Sometimes it's macro, sometimes it's unit economics, sometimes it's impact. And then we actually didn't know exactly. I think it's because maybe the methodology is not well publicized yet. I mean, I'm sure it's very well developed internally, but I don't think that it is common knowledge about the IMP5. I think that's why you explained it on stage, right?
Yes, exactly. It's something that actually when we were speaking to you guys, it's something that we were in the midst of fine tuning as well.
Okay. Was read.
And yeah, so we internally when I was there, we only used it fully maybe 3 in investments taken to the IC, and 3 investments that went through. So,
nice.
we have to do it for every single investment, right? But yeah, so it's and I think I'll spend maybe a bit of time talking about how we set this up, right? So For investment to be considered an impact investment, you have to pass the test of additionality, right? Which is that if not for my capital, this particular change that you're trying to drive in the world will not happen. And you're investing with an actual intention to actually create this change in the world. Very different from ESG investing. Where ESG investing is you can invest in anything that you invest in any day, right? You're a bank or a widget company and so on, but they have to meet a certain level of hygiene. They have to tick off certain DEI boxes, sustainability, have your carbon emissions, scope 1, scope 2, scope 3 mapped out. So you're doing your regular business, but you comply with certain things. Whereas in investing, you want to create a particular outcome in the world. So you start out by setting up what is the theory of change. So what is the current state of the world, and what's the problem statement that you're solving, and how is it your company or your project is actually changing this? And you define what the inputs are, what the outputs are, and what the outcomes can be measurable that's coming out of this. So like, in Earth's example, you're a company that does e-waste recycling, and you collect from homes, and you employ heroes, your B40 heroes to go and collect this, so you provide income opportunities. You take the e-waste, you sort them to grade A, grade B, grade C. You either resell them or you donate them, and grade C you can recycle them, right? So right there you have all your outputs, and then your outcomes is I think your metrics like your tonnage diverted from landfills, and you're very good in that you actually produce a report. So just saying that the theory of change writes itself, right? And then from there we then put it into the impact management framework and the IMP5. Talk about what's the goal. So the goal here is obviously to reduce landfill. What is the change that's being driven? So talk about that. What's the additionality that's being driven? Who are the beneficiaries? So we already know the beneficiaries are the P40s, the environment from recycling. And then we talk about what the risks to the impact, not the financial risks, but what the risks are to the impact. What could go wrong in trying to actually put in running these activities. And one example that I shared in the session, which is what we heard when we spoke to a lot of large institutional investors. There was one project in Africa where they tried to replace the fire. This village, they use charcoal and firewood, and said use gas stoves instead, because then less time, it's safer. We would have more time to do other things and so on. So that's a big project to give them gas stoves. Came back a year later, and what they found was cases of malaria and dengue had gone up. So obviously, what this charcoal smoke comes out, right? And smoke keeps mosquitoes away. So there's all these risks to actually the impact they're trying to create actually has all these unintended consequences, right? That's a very kind of a textbook example of what the impact to risk can be as well. So to close off, for every impact investment, you have to have a theory of change. You have to know what you're changing in the world, and then you have to have a very clear framework to measure it on top of your normal financial assessment as well. So I spoke a bit about that. Melissa spoke a bit about what's the difference between your VC and your PE versus your normal impact investing, and we spoke about the general state of the industry in Malaysia and how we go about finding kind of more and more companies that do this. How is it an increasing trend, and how is there's a huge funding gap for this space in terms of trillions. If you think about the challenges facing the world, your climate change, your poverty, your financial inclusion, and so on, there's a lot of capital that needs to be mobilized to doing good in this way. So yeah, I think it's a very kind of powerful and quite informative session. At least I hope it was.
It was one of the best sessions in the summit. And then after that, there was the next segment was generative AI and angel investors. So the sentiment that I was getting was that yes, AI is booming, but it's kind of too late to join the party now. Well, actually, I think looking at the last 3 years when investors were snoozing, okay, maybe that's why you're late. That would have been the time to invest. I actually didn't think what was the point of this, because that sounded to me like a very dry workshop, and you could have delivered this information to the MBAN members, for example, in a webinar or something like that. But I think that someone who's putting the summit together was like, hey, we have to have an AI segment, right? So okay, let's get a guy to talk about intellectual property, how to evaluate AI companies, and then he was like putting a do's and don'ts of what kind of companies are investable, what kind of companies are just hype and fluff. So I think, yes, that's again helpful to maybe angel investors who are curious about AI but they don't know where to start. But I just didn't think that was the right setting for delivering this kind of message.
So maybe slightly belatedly, right? Like, I know Omar was explaining a lot about that impact investment methodology.
Sorry, we didn't cover that.
But I think there's a segue in between both, right? And this was something that we probably spoke about multiple times around. Like, you're talking about people missing the boat on AI and so on. And I mean, if unless you've been living in a cave, right? Everyone has been pitched an AI idea in the last 2 years. Yeah. Right. And there's just so many of these companies coming out. But like my question and the relation into the impact investing is like, what's the takeaway for an entrepreneur starting out in impact and approaching some of these angels who may or may not be aware, right? And the other question is like, are there enough deal flows of impact, and do people even as entrepreneurs start like where in that three methodologies, right? Like, what's the starting point, right? Do people come out and say like, I want to start an impact based company. I want to be this, that is the driver of change. But to be a driver of change, obviously it requires a lot of capital. It requires social capital. It requires actual dollar capital, right? And obviously it's great to hear the methodology around it. I'm just trying to think like, what's going to be useful for impact entrepreneurs, or at least people who are starting to think about impact entrepreneurs. And was there any takeaway for how that's communicated with the kind of like potential first check investors when you're in impact?
Yeah, so there's a few levels or a few ways around this, right? So so first, there's impact businesses such as Earth, and then there's also social enterprises, right? So and sometimes it's a bit of a gray area between the two, right? But to a certain extent, all of these that tend to be funded by this big umbrella of like either impact investors, or you have your grant providers, you have your foundations and your philanthropists, and so then, and I spoke about this a bit at the summit as well. It opens up a whole lens of like blended finance, right? So and if you're an impact entrepreneur, you need to realize that you need to do some work to find out what is the right modality of funding for your particular investment. It could be an equity style investment, pure investing, which is what we did with Earth. You could need a combination of grants and some kind of blended finance. But also, when you speak to angels as well, you also want to tap into businesses and corporates to kind of attach themselves to what you're doing, right? Like, for example, what Mo is doing is not necessarily just opens it up to investing, but also you're building a corporate business as well, right? So to the extent that you're also pitching as a business to these guys, so a procurement as well. So and a lot of people want to do good, right? So you get feel good factor, you get you want to refer to different parts of your business, or you maybe want to put your own charitable money to use as well. So it's I would say for the impact entrepreneur, whether you're in pure entrepreneurship or social enterprise or kind of entrepreneur, it's good to kind of expose yourself to these kinds of forums, and because you don't know what kind of doors will open and which kind of avenues will actually result in something, because it's such a new kind of stage, and a lot of people are very interested in it, I would say.
Speaking of doors, so the next segment was basically 6 companies pitching enter the tiger's lair. So the panel had people from the sponsors of the event. So there was someone from Hong Leong, I think someone from um, uh, MSW Ventures, which sponsored the trip of the Carousell founder, and I think the entrepreneurs that were on stage, they were very passionate. I think one of them, the one who actually won, was a Singaporean company. He actually did 2 exits before, and everybody was very passionate, regardless of whether their businesses were good or not. I mean, it's not for me to judge, but I think they really didn't know what's in it for them. I think they thought it's good to win this thing. They are at different stages. Some of them already generate revenue, like America, for example. The expert platform or the skills platform. They are very well established, and they were pitching. They didn't win, which was surprising to me. Not even runner up, even though they are very strong in the market. So and then there was also like a couple of Taqwa Tech ventures, thrown in for good measure, right? So there was someone, like trying to tick all the boxes and have everybody represented. It was actually quite big representation. Like 2 Taqwa Tech companies out of 6 is actually quite big. But yeah, I actually empathize with the entrepreneurs, because I actually remembered myself 2 years ago when I was in their shoes, and I pitched very passionately, and then in the end I got nothing, and I suspect that these guys also gonna get nothing, because for example the Singaporean entrepreneur who actually did win, he is already good friends with Jeff from MSW, right? So it's not like he's coming to this to meet Jeff. Like, he already knows him. Probably maybe flew even together from Singapore. So like, what's in it for him? Like, well, why did you actually take the flight? Okay, you're gonna get a social media post, or what is actually the point? So that was my impression. Did you attend the pitches, or
No,
okay, you didn't attend the pitches. Never mind. But they were good. They were passionate. Very interesting concepts. Some of them are at different stages. As I said, Medica well established. Others are a bit earlier on.
But I always credit people who show up.
Yeah. Showing up is the prerequisite to winning.
Yeah, and I think like that's part of that journey, that grittiness. Like sometimes you really don't know what's the door that could open for you, right? Like, but showing up is kind of like half that battle won, and then what you make out of it, I think.
No, I agree. But what I disagree slightly is that the outcome of spending half a day at this kind of event just can't be 0. It's unacceptable for it to be 0. Regardless of how little or how much it is, it just can't be 0. That's my view on that. Because I was in their shoes 2 years ago, and I won. I did everything, etc. And at that time, I was a new father. My kids were barely a few months old. It was actually even tough to even be there, right? Because my little kids needed a lot of attention in their in the first few months, and I just took time away, and I went and I pitched and I won, and then nothing. So that was weird.
Maybe this is a question back to you,
Yeah.
right? Like, Mo.
What was I looking for?
Yeah, what were you looking
What
for?
will
Right?
make
Like,
it work
Good
for
question.
you,
Yeah.
right?
Yeah. What would have been good? Okay, of course, number one is if we would have gotten a conversation that could lead to funding. That's one. Absence of that, it's fine. A conversation that leads to discovering some things about the business that I can improve, right? Or at the very least, throw into the judges some corporate executives, for example, so that at least if the entrepreneur isn't getting funded, he might get 1 or 2 procurement contracts, and then at least he feels like he got a positive outcome out of that. But just getting nothing, getting a meal and some applause, it didn't really feel worth the investment, to be quite honest with you, back in 2022. It was a very nice place. I think we were in DC Mall. Nice hotel and nice meal. And
So,
Yeah.
my question to you then, would you say all of your subsequent success, fundraise, and everything else, would any of that not have happened at all if not for this?
so you're saying that
If you didn't win, if you
Yeah.
didn't have that, even if it's only just bragging rights, right?
yeah,
In the absence of that, would you still do you think
exactly the same outcome.
It,
It has zero
didn't change
effect.
the trajectory of the
Nothing.
subsequent
It didn't
years?
even get me one lead. Not one lead, not one customer, because at that time the sponsor was Hong Leong Bank, which I've already been working with at that point for almost a couple of years. So I was there, sort of meeting, like old friends from Hong Leong, and then some, the current president at the time, who basically rejected me, 2 years ago, and gave me zero feedback, and still not giving me much feedback even now, during that event. So it just didn't feel like a good investment of my time, to be
Maybe
honest.
since you're also in impact, right? And then taking some of the feedback that Omar mentioned, did you feel like you had to do extra homework to find which investors were right for you? Because I think, like, a couple of points
Excellent
together,
question.
right? Like Gen AI, you pitch everyone who's not been living in a cave.
Yeah,
They
yeah.
understand that. But
Yeah.
did you feel like you had to do extra homework to
Yeah.
find the right investors?
Okay, so you actually know this story. We were rejected by Gobi, I think, 4 times, with varying levels of feedback at every rejection. And then I remember the second rejection, which was somewhere around 2020, I think. I told Gobi, we actually grew from pre-COVID to post-COVID. Our revenue grew by 15 times, right? So we were on a very, very good trajectory. And then they said, okay, good progress from the last time we rejected you, but the numbers aren't still big enough, because we are sort of a fiscal investor and our investors require a certain level of return. And then I was like, but I'm impact, right? Like, look at all these e-waste that I'm diverting from landfills. Look at all the gig workers that I'm giving jobs. Look at, all the good things that I'm contributing to society. And then they were like, actually, that's not a criteria at all. We just look at the numbers at the time, because their LPs at the time were just after the returns. Impact wasn't a thing. Fast forward to 2022, 2023, when we were talking to Dana Impact, and then Dana Impact became the LP to a fund that Gobi manages. Now suddenly, because the LP gave Gobi the mandate to go after impact companies, so the same one that only cared about the numbers a few years earlier now also factors in impact. So accordingly, we started the conversation.
So, I mean, to that context, right? Like, somebody who's coming out, and we've heard this advice multiple times. I think I've heard it. You've probably heard it. Like, in order for you to get investments, you need to talk to as many investors as possible. And I think, to your point, like, there was a very clear, for some investors, that reason for rejection is kind of like, the absolute numbers are not yet near where we would like to invest, right? But then herein comes an investment mandate that has an impact angle, and then it changes the game slightly, right? But would you say that the baseline for a new startup to score an investment, you need to decide and do your homework, which investors are going to be making sense to you, right? Because it feels like that's baseline for you, right? Or it could be like every other startup that is maybe, again, using the Gen AI example, like, you just pitch to anybody who has $1 to give, right? But
When I'm at VC stage, I absolutely agree with you. You need to do your homework. You need to filter it down. Who are the ones that invest in your ticket size, in your sector, etc. But this episode isn't about VC. We will have a VC episode soon, but this episode is about angel investors. Angel investors invest for different reasons. Sometimes they invest because they play golf with the founder. Sometimes they invest because they like the founder, sometimes because they like the idea, etc. So the thing is, VCs have already parameters set that they can only operate within. Angel investors, it's free. You can do whatever you want. You set the parameters. You invest, big ticket size, small ticket size. You give him a safe or equity funding, or you give him venture debt or whatever. You have the flexibility, right? So I don't think that. So I totally agree with your point at VC stage, but at seed stage and ideation stage, I don't think that you should do so much homework, or even that you can do so much homework, absence of the support of something like MBAN, which would give you a public database of these are the active members and these are the observer members, so that maybe you invest your time on this column, not on that column, right? You only pitch to 6%, not to the 94% who are there for a nice meal and high-fiving each other and meeting old friends, right? So that is just what I think would be beneficial from an entrepreneur perspective. Anything?
Okay. It won't answer your question.
Okay.
But I think the fact that you had that badge of like winning the MBAN, like it helped in.
Did you know I won the MBAN Tigers Lair when I met you?
It was amongst the various accolades.
Okay, so there was a big list and there was one line there.
Yeah,
Okay, good to know.
Yeah.
Well, I didn't put it in the slide, so I'm sure that was your own due diligence. Maybe. Yeah. Okay, but okay. Thank you for letting me know that the time I invested that day added a line to my due diligence points. Okay, so the next segment, and I'm really and I say this really in the spirit of constructive feedback. I would really urge the organizers, when you have such an important guy, don't give him 30 minutes, the same like you gave, sort of another local guy who was pitching, like some, government program or something like that, because, right, this is rare, right? Like the government entity is always going to be there. They're going to have many opportunities to tell their story, but this guy doesn't come often. And we don't have many unicorns here, and we're trying to, as a nation, build some unicorns. So maybe we should learn more from the unicorns. So I was actually a bit disappointed. Luckily, I also had dinner with him later that evening. Then the next morning with the Soonicorn Collective, we spent 2 hours. So for me, I got to all the information that I wanted out of Marcus. No problem there. But if I would have paid 500 ringgit ticket, entrepreneur ticket, to go to the event and only listen to him for 30 minutes, I would have felt that is missing a bit of a trick. So would you agree with that, or you think he was allocated the right amount of time?
Okay, if I had paid 500 ringgit, I would definitely want to see more entrepreneurs. But I don't know if more than 30 minutes falls within the attention span, if you know what I mean. I think just expanding on your point, I think having more examples of like entrepreneurs, people who've succeeded, and actually offering something more would be a value.
Or at least opening 15 minutes of audience questions. I mean, this was 30 minutes just Doc and him talking, but I'm sure that auditorium would have at least had 10, 15 minutes worth of questions for him.
Yeah.
Actually, that's one thing I noticed. There was not Q&A.
Yeah.
Because I think when you came and we had a quick chat, right? Like we were already kind of like, oh, there's some good burning questions that I would like to have asked Marcus, like, especially around that starting journey. A lot of parallels that what his business versus global, because this is one of those rare occasions where we can benchmark this business against a global arena of different businesses as well, right? Yeah. Because it's reached a scale where it's one of the top names in Southeast Asia and probably comparable in terms of the impact towards the customers that they have this part of the world as someone like an eBay, for example, like had in its early days in the US. And so we had, even in our short chat, like, oh, obviously Mo was able to spend a bit more time, so we like, hey, ask this, ask that.
And I did share the highlights
yeah,
and the
yeah.
and the script back to you, or the transcript
Yeah.
actually back to you. Okay, the next segment, I think we both attended that one, was basically supercharging Malaysia's startup ecosystem, aligning public-private initiatives, and engaging the next generation of investors for maximum impact. Actually, that panel was nice because actually there was, I think it was all women panel. I think.
I think the moderator was
Or just the moderator,
Yeah,
but the rest was
panel was, yeah.
yeah. So I think that was good. I think there was some breaking news kind of sound bites that came out of that. Like Nuremi Ismail talked about what some of the states are doing or intending to do in the field of venture capital. So some states are now also becoming interested in playing a role, which is very interesting, right? Because normally in the rest of the world, or let's say, actually let's take Korea, because Korea was actually mentioned in that panel. So they said that public-private started off funding-wise with 50-50 split. And then today, the public component is less than 5%. And 95% is carried by private. And then they talked about Malaysia. And in Malaysia, it is 70% government and 30% private. So tell us a bit of perspective about that.
Yeah, so we
already talked about it so many times.
So we studied the Korean model in quite a lot of detail, and the Korean model, the Singapore model, the UK model, and the Koreans definitely did it well in that they started off with a lot of heavy government involvement, and then as time and they really focused on certain sectors. So this year it's all about E&E. It's all about like whatever it is, and then they really double down on it. Government really give concessionary capital. They don't mind if they lose money in the first few years. They got to succeed and create all these companies, and then and they really push them, right. And then as they kind of took off, government took a backseat, focused on new areas that they wanted to take off. So the very sectoral approach, right. So and that helped to kind of spur the ecosystem quite a lot. So it's very instructive what they try to do.
So since you have looked at so many ecosystems, have you ever come across one that has such a high component from government?
So obviously we've not studied every system in the world. I'm sure there are.
Yeah, but I asked, did you see one that had such a high? So we are kind of exceptional, right?
Yeah. We are higher than most of the global benchmarks. The ecosystems that you would benchmark yourself to, we are higher than.
So that's hopefully an area of improvement. Maybe the government's role can, be right-sized in the coming years. I think that would only happen if the 30% part expands rather than asking the 70% to shrink, because that's also not good. But let's say the 30% should expand to take its rightful position in the pie. Is that how it should go? Because it sounds to me like some of the announcements that were made in this panel, it sounds to me like actually this 70% is going to grow.
I do not know.
The sentiment does feel that way, and I think we're talking about private capital. I think literally we could count private funders, and I'm going again beyond the angel stage, right? Like you could literally count probably with one pair of hands the serious capital that can be deployed, VC money, for example, right? And even then, a lot of that is supercharged, to borrow their term.
I want to know who writes the teaser paragraphs, because they're all
right. But they are supercharged a lot by the influence of government as well. Right? So it begs the question as well. I'm not sure like this was specifically covered in that segment about growing that 30%. Where is it going to come from? Right? Does networks like MBAN have a role to play in it? I'm pretty sure there is, right? Again, on both sides of the table, one supporting the deal flows, two is then investing and educating the existing network. Right? Like, when I say investing, hopefully and enlarging that 6% active investor pool, right? To enlarge the absolute number, you could probably have to invest in making that membership 700 people, right? And then even with the same 6%, you still double up the number of investments that you make, right? But what are those? I mean, it sounds like it's a tough thing as well, because corporates are also a lot of the I wouldn't say destiny, but a lot of the agenda, a lot of corporates in Malaysia is also intertwined with government policy, right? So where is that route for new money in the private sector to come in? I have some doubts about growing that in the near term. And I do like to think that if one way, it's bringing founders back to the table, right? The likes of the exited founders, and in no ways trying to over glorify, but to bring them back to the table to fund a lot of these things. To a certain extent, I wish that role was played by a lot of the millionaires of the last 20 years who have built very successful businesses and maybe could be or may not be part of MBAN. But I think
Do you think that is happening? Do you think there are active angel investors out there that are doing a lot of deals? It's just that they just never register for MBAN.
I think without name checking anyone, I mean, I know people who've done anywhere from like 5 to 15 deals and are not part of the network. Right? And that, whether this is coming back to a bit of this Malaysian culture where you don't want to shout about success all the time, right? But there are.
And you see a bit of that in the Penang example.
Yeah.
It's work about, right? Closed ecosystem. They invest in themselves. So I'm sure behind closed doors there's
a lot of deals.
A lot of that happening in Malaysia as well. So I think that's.
But what does that say about the role of MBAN and the authority of MBAN in the market? Is it achieving its objective if actually a lot of the deal flow is off book?
I mean, I don't think MBAN has actual authority per se. It's not a regulatory
At
body.
least thought leadership.
Yeah, correct. It has a role to play for sure. And I think it's because it's more public, it's public facing, and so it has that kind of flag bearing kind of role that it can play, and it provides a platform for a lot of people who don't have access to these private networks, right? So the everyman, right? So in that way, it democratizes this early stage in investing for both sides.
I think not to the extent of crowdfunding, though.
Not to the extent, no, obviously, because it's still angel. It's just talking about individuals.
Okay, great. So I think we are coming to So we're basically coming to the closing session. I think a lot of people actually didn't attend the closing session, myself included. Admittedly, I wasn't there because I had to rush to the dinner with Marcus. But all in all, I think now we can maybe just recap. I think it was a nice event. I enjoyed my time. I met friends. I learned some new things, not as much as maybe I would have liked, but it was an okay day to spend. But maybe I'm just talking about the wider picture. And by the way, Mike, whatever I said today is not about the organization. It's more about what is the role of the members, and that I do believe that these 350 MBAN members definitely can play a much bigger role in our ecosystem, if not for investing, at least mentorship, at least pushing the ecosystem forward. So all in all, maybe summarize your impression of the whole thing, and then maybe give some advice to entrepreneurs as to how to interface with these kinds of networks.
Yeah, so I think it was a very well organized event. Very, from my perspective, it's very balanced in the sense that it brought in all the different stakeholders. So if you're a first time entrepreneur, you get a good taste or an example of what's out there. You got the government, you got the impact, you got the previous examples, maybe for seasoned entrepreneurs, and I would say maybe they might be less. So for someone savvy like yourself, with all the comments that they make, clearly shows that if you have a hunger for certain outcomes, maybe MBAN can think more about how to satisfy that demand. And I think it's a very valid point, right? People are hungry for capital and mentorship, and maybe go straight to the point and provide
And deliver that. Yeah.
Yeah.
Great. Any final thoughts?
I mean, a lot of the segments that we've gone through, I think it feels like they open up a lot of new questions as well. Right? Like I don't think like in any summit you have the answers to every problem in the room, but I think there's still, from my vantage point of still being more interested in operating within the business rather than on top of the business, like an investor would.
Yeah.
There still feels like that situation where you really need to pick the right battles that you want to win, right? Because the time is limited. You need to build a business on top of raising capital, and then and the I see a lot of challenges for ecosystem, but I'm also very bullish at the same time, because like the thing that with a lot of entrepreneurs have always complained about is that there's not enough money in the system. Right now there is money.
There is. Yeah. We don't have a funding window.
We don't have a problem with there's no money to be invested in. So I think there is this particular point in time right now, right? Like where founders who kind of like up their game, I think have a chance to win. Like and it's not necessarily a free for all kind of thing. Right? I think the two main points that I really want to see. I think there's right now we've reached a stage where there's a lot of second time founders. Right? There's also a greater awareness among people who've worked 10, 15 years in a corporate environment and then coming out to start their own companies. They're not starting out of right out of college, and you would like that blend across the spectrum. But my point will be, if in terms of like scoring an investment, I still believe in things like showing up. And showing up at events like these does make sense, right? Like you especially if you're a first time founder. I think there's also my personal point of view as a second time, it doesn't automatically create a duty to give back, right? But you can give back at a minimum of one of two ways, right? Like mentorship,
knowledge or money. Yeah.
knowledge or money, right? And if you can write, and I think like if the qualifying criteria is to write a 5,000 ringgit check and then, hey, I'm an angel investor, and then it's
But even that is not happening. I mean, even
exactly,
that.
right? But I come back to the point about like founders backing other founders as well, and I think that's a lot of what the Soonicorn Collective is trying to do.
Yeah.
Right? And sometimes there is this kind of inflection point about, would you give first to receive? 5,000 is not a lot of money. I think for a lot of founders, every dime is important. But again, come back to portfolio allocation, right? You have a number for what you want for your company, and you'll be willing to go down that route of like using savings and so on, right? But you also have savings that are meant for you to protect your future or your family's future and so on. And there's a bucket for investment, right? My key point would be, take a look at your investment bucket and see where are you allocating, right? Step into the mind of an investor, right? Because the angels have a thought process as well. They like people who are interested in investing in other companies or in other people didn't reach that stage by chance, right? They're not complete idiots. And there's that inflection point, like where would you put your money if you're a founder right now, right? Like 5% safe money, right? Are you willing to bet on other founders? Are you willing to bet on a founder who's adjacent to you and say that, hey, I want to know the people that invested in you, right? I want to know it. Are you willing to part ways? How far are you willing to go, right? So this is my point about like trying to say, it's now now's the chance to do more, to show up, right? To be out there, to network, to mingle, because there is this window, and I don't think this window will last forever.
In our last episode, Sharmalachu, we were talking about teams and corporates, and basically he provides tools that help big companies address invisible leakage. And the definition of invisible leakage is the difference between where you are and where you could be in the best case scenario. So I think our coverage today is actually in the spirit of trying to identify this invisible leakage of, in the best case scenario, what would be have been the role of MBAN, and how much could it have pushed forward early stage entrepreneurship in Malaysia, so that we can later have, VCs investing, and then internationals investing, and then hopefully, exits and IPOs and all the good things after that. So, guys, it was an absolute pleasure doing this with you.
Thanks for having us.
Thank you very much, Omar and Alvin. I would like to remind our listeners that the opinions, views, and content expressed on the Soonicorn Nation podcast are those of the entrepreneurs and guests featured, and do not reflect the official policies or positions of Proficio Consultants, Pinjana Capital, or the rest of the Soonicorn Collective. When it comes to angel investors, you're not auditioning, you're interviewing. Remember, it's the market, not their checkbook, that will ultimately validate your entrepreneurial vision. Join us again at Soonicorn.